Earlier in Hot Picks, we covered the consumer discretionary sector. Our guest was Filippo Falorni, Director of US Beverages and Household Products at Citi Research. We began the discussion with the macro backdrop and how it's likely to affect consumers.
Macro backdrop is clearly deteriorating in the U.S. Many companies are starting to talk about consumers pulling back on their consumption levels. Ultimately, look, my space is a little bit more immune from some of these macro backdrop. I cover categories that really are daily use categories, especially in the household product side. So these names have been viewed pretty defensive throughout prior economic downturns. And you saw in the early phase of the market sell-off that these names held up a lot better, especially on Thursday. Last Friday, you started to see all the consumer group, including staples, really underperform as well, as the market is kind of like extending those declines. But look, ultimately, with the macro slowdown, a lot of my companies are going to be relatively more immune compared to the rest of the economy.
Okay, let's jump into your picks. Your top pick is Keurig Dr. Pepper, ticker symbol KDP. Why is that your number one pick?
Yeah, so we moved it recently to our top overall pick because we think the fundamentals of these companies are really underappreciated in the current valuation. So they have essentially two businesses, a coffee business and a refreshment beverage business. The refreshment beverage is more the beverage side, so the Dr. Pepper, Canada Dry, and some smaller brands that they're selling almost entirely in the US, like 90% US exposure. So much less at risk from tariffs and from international trade wars, and that business is growing significantly in the mid to high single-digit range. It's been an area of strong growth for the company. They continue to gain share within the U.S. beverage business from Coke and Pepsi, and they continue to expand their distribution. So that part of the business has been very solid. The coffee side has been a little bit softer over the last couple of years, but ultimately the company has provided pretty conservative guidance within coffee, and coffee is one of those areas where, because of the cost inflation moving up, there's opportunity for KDP to take pricing. They've assumed pretty significant volume elasticity for pricing, but ultimately, if they're actually able to take price and consumer doesn't change their consumption behavior significantly in coffee, they could actually have upside both on top and bottom line.
Okay, number two is Monster, ticker symbol MNST in the U.S. market. Why do you like Monster?
Monster plays in the energy drink category. That's almost 95% of their sales exposure. And that category has been particularly solid in the US. We've seen some softness last year when you started to see some concern among low-income consumer on the category, but now it's started really to reaccelerate significantly in the US. A lot of it is also the fact that this category historically for the past decade didn't really have a lot of healthier options. And now there's been all these new brand introduction. They have zero sugars, they have better for you energy, and they've really expanded the consumer base of this category. And then Monster, being the number two player globally after Red Bull, have still a solid opportunity from a market share standpoint in the US, but even more in the international market. If you look at the US market share, it's about 32% compared to Red Bull at 33, 34. So pretty much neck to neck with Red Bull in the US market. Internationally, Red Bull has over a 35% market share versus Monster only a 10% share. So it's a healthy category, and they have significant market share opportunities that makes it to us a very compelling story.
Okay, and your third pick today on Top Picks is perhaps the best known name in the beverage industry, Coca-Cola.
Absolutely. Yeah. So look, Coca-Cola has been our topic of over the prior year. We moved it a little bit lower, but it remains our favorite multinational within the group. So multinational clearly have a little bit more risk from this global trade war. From a tariff standpoint, there's not a lot of direct implication for Coca-Cola, given they produce almost entirely locally in every country. But there is some risk from anti-American brand sentiment around the world that we've seen. I would say Coca-Cola remains are favorite of all the multinationals because their actual fundamentals remain very solid. They have about 40% of sales in emerging markets, which they can actually drive volume and price growth. And even in the US market, they've been able to diversify their portfolio away from carbonated soft drinks, which is their main product that everyone knows, into better for you categories. More recently, they've acquired Fairlife, which is essentially a dairy protein-based drink option, including Core Power, which is their core SKU. And they've really been able to grow that part of the business a lot faster than the core carbonated soft drink side of the portfolio. So even the US market, they're actually able to grow volume, which has been pretty remarkable. And then internationally, they do have a lot of opportunities in emerging markets.